Want me to do some bombastic, lead in to this thing? Welcome to the first episode of Dean's List. I'm Dean Lyulkin, and I'm excited to be with you today. The reason I created the show is to help individual investors cut through the noise and focus on information that will help grow your wealth. I spent the early part of my career at industry giant Fisher Investments. Then I left my very senior role to lead Cardiff, America's favorite small business lender, with my closest friends from childhood. After almost 2 decades of successfully growing our business and serving accredited investors, I created Dean's List to help you avoid mistakes and make better decisions with your money. Long term, I have another important goal, and that is to build a community of smart investors with at least $500,000 in liquid assets who can one day form the foundation of an investment advisory firm. Here's how we're going to do that. This show will cover a short list of important financial stories, and I'll give you my take on their impact to my investment outlook and strategy. Dean's List is built on 3 key concepts that will guide our thinking about the headlines and help us make better decisions. First, the market is a discounter. Did we learn something new the market hasn't fully appreciated? To be honest, the answer will almost always be no. Number 2, most of us can't control our emotions. And boy, do we hate losing more than we love winning. This is called loss aversion, by the way. We'll talk about that later. This leads us to do stupid things like stay in an investment or fear shifting strategies long after we realize we've made a mistake. We'll try to recognize and control our biases together. And finally, number 3, do our investment choices reflect our risk tolerance and long-term goals? Sometimes overconfidence, the opposite of loss aversion in many ways, leads us astray. We fail to benchmark our performance and make silly decisions as if we're sitting inside a casino, playing a game designed for us to lose over the long run, not the other way around. Now let's get started with a quick look at year-to-date performance of major stock market benchmarks. We'll start with the S&P 500 up 20% year-to-date and 5% for the quarter. NASDAQ 100, representing technology stocks for the most part, is up 19% year-to-date, but only up 1.5% in Q3. And the MSCI EFA, representing Europe, Australasia, and the Far East developed markets, is up 11% year-to-date and 7% in Q3. The Russell 2000, representing small cap stocks, plus 10% so far this year, and 9% in the third quarter, with similar performance in Q3 from the equal-weighted S&P 500, showing that the breadth of this rally in the third quarter is tied to changing interest rate expectations. 2024 is turning out to be another fantastic year for the average investor. Alternative assets like precious metals and crypto have done well too. The only way to screw up would have been to take enormous individual security risk and end up on the unlucky end of some names you heard about on CNBC or from your friend Bob, the 5-minute chart trader who loves technical analysis. It's been a tough 5 and 10 years to be an investment professional. Stock pickers have been slaughtered. Any Joe from Jersey could throw a dart at the 10 largest stocks, pick a couple or all of them, and trounce most benchmarks, hedge funds, and the highest paid professionals. Warren Buffett, your buddy's getting old, but pay attention to his stockpile of cash. He and other smart investors know this too won't last. Overconfidence can be deadly, especially for those of us in our 40s or even older. Overall, I am and have been positioned for about a year now with 25% in short-term assets earning a healthy yield, 60% in the S&P 500, and a 10% allocation to smaller US companies via the Russell 2000 and an equal weight S&P 500 ETF. I continue to have single-digit allocations to precious metals and the largest cryptocurrencies. Shied away for the most part from foreign equity exposure for many years, but I won't rule it out in the future. As we look ahead, expect some volatility in the fourth quarter. The election should bring some surprises for everyone before the holidays roll in. And remember, the first year of a presidential term is tough for markets to digest. Why? Because it creates more winners and losers than any other year as regulatory and legislative change rolls out. Whether we get a quasi-lame duck Kamala Harris or a second coming of DJT, it won't be a typical new face in the White House. Rest assured, the world won't end either way, and markets will separate campaign bravado from the harsh reality of the legislative process relatively quickly. As for the Federal Reserve, there's no question those folks deserve a round of applause. Whether they engineered the soft landing we're in today, or they just got lucky. So many pundits give Chairman Powell and the Fed a hard time. It actually feels contrarian to say something positive. Now let's jump into some headlines. First, did I miss AI? No, you didn't. Let's talk about the huge investment Google made to bring back one of its top AI developers. The Wall Street Journal reported Google spent $2.7 billion to bring back Noam Shazir. He left Google in 2021. The guy co-founded Character.ai, some chatbot startup. You probably wouldn't pay $2.7 billion to bring back your dog from the dead. So what's the deal? I hope every single one of you is using OpenAI's ChatGPT and paying that measly $20 a month for the best version. It's an efficiency machine for business owners, marketers, writers, and humankind in general. Oh, it'll also give you investment advice, despite that being against the SEC's wishes. It's a deflationary, exponential force all by itself, I believe. The company behind it is in some hot water recently. A recent journal article, Turning OpenAI into a Real Business is Tearing It Apart, reveals that Sam, the CEO, who got fired and brought back, is losing executives faster than my mom lost weight on Ozempic. For investors, here's the key takeaway. OpenAI is 49% owned by Microsoft. So whether you realize it or not, if you hold that stock directly or indirectly with a bunch of ETFs, you're already exposed to AI's future. Criticism and concern about OpenAI's direction might feel familiar. It's similar to what people were saying about Tesla about 10 years ago. Is Sam Altman the next Elon Musk? Remains to be seen, but Microsoft's heavy involvement in AI, particularly through OpenAI, means that investors are already tied to the field's leader, whether they like it or not. So don't fear missing out. Google is probably an investment holding of yours too, and its Gemini AI is making strides there. Just ask Google a question and see what happens, and you'll see Gemini in action. Individual investors that do this alone might have a deadly virus. We've already touched on AI. Now let's discuss a concept that can really influence how you think about investing: loss aversion. Nobel Prize winners and best buds Dan Kahneman and Amos Tversky, as told in my favorite Michael Lewis book, The Undoing Project, showed that people hate losing much more than they love winning. There's an article about them almost every week in the Wall Street Journal. They're that important. This phenomenon, known as loss aversion, explains why many investors hold on to underperforming stocks for way too long, or avoid risk altogether, even when the upside could be significant. It's human nature to feel the pain of loss more intensely than the joy of gains. The psychological barrier is one of the biggest reasons individual investors tend to underperform, because they make emotional decisions in the face of volatility, rather than sticking to a disciplined long-term strategy. What are you being dumb about in your portfolio? If my cash pile turned out to be a solid choice in 2022, after I read some article about Joe Biden's economy and the market was down while everyone adjusted to inflation, I probably stuck with that theme in 2023. That was dumb. Now we're in 2024, deep into it, and I won't look at my portfolio anymore because it hurts too much. I can pretend it's not there and cause my family long-term harm. We should all get better help if we recognize these behaviors in ourselves. Next, is the American dream out of reach? One final story for today touches on something deeply personal for many of us: the idea of the American dream. According to the Wall Street Journal, many Americans feel the dream is slipping out of reach, especially when it comes to owning a home. Why do journalists love writing stories about this topic? Simple, they get eyeballs, that's why. But here's the thing: the American dream is about achieving freedom, not owning property. I would argue there are many more ways to be financially free today than in most decades past. Investing itself has become more democratized, accessible, and cheap. Yes, income inequality is real, but we aren't going to stop globalization or tech advances, and we're not going to be victims. The answer for young people isn't to lament the lost ideal of home ownership, but to focus on moving to or near big cities, becoming more educated, and being the best at something, not just following your passion for the sake of it. That's the real modern American dream. Freedom, both financial and personal. The key is to set yourself up to thrive in the new economy by developing skills and creating things or businesses the world needs. Thank you so much for tuning in to the first episode of Dean's List. We covered a lot today: third quarter market returns and outlook, AI's potential, investment psychology, and the evolving meaning of the American dream. Bigger takeaway is to stick with the three concepts we discussed early on. Assume the market is smarter than you are, and it'll make you look stupid at every turn. Control your emotions or pay a hefty price in missed opportunities or losses. And most importantly, check your ego at the door when you realize you need professional help of all kinds. If investing is giving you heartburn lately, by the way, I want to draw your attention to Cardiff's current offering of stable, high-yield corporate notes. We use these notes to fund our small business lending activities. Click the link below if you're interested to short-term, volatility-free investment that's paying higher returns in the stock market since 2018. Long term, the goal of Dean's List is to build a community of engaged investors who may one day become clients of our future investment advisory business. Thank you so much for watching. I'll see you next time.